Hello, welcome to monthly debt outlook from Canara Robeco. I am Avnish Jain. Geopolitics continues to remain uncertain and volatile. A temporary ceasefire of about 60 days was negotiated between US and Iran to further discuss main points leading to nuclear weapons as well as Strait of Hormuz. However, the ceasefire was fragile and short-lived. Early July, hostilities again began between US and Iran as Iran attacked vessels in Strait of Hormuz. US retaliated by attacking Iran for almost 10 to 15 days. Despite this, Iran continues to attack ships in Strait of Hormuz. Another escalation has been that the Houthis in Yemen have started attacking vessels coming out of the Red Sea. This Red Sea has been used by Saudi Arabia as an alternative route for oil going into the world markets as the Strait of Hormuz was blockaded by Iran. This creates another problem as both the outlets out of Middle East are being now blockaded by Iran and the proxies Houthis. In the interim, when ceasefire was announced, it was a sign of relief for the world. Oil prices crashed to around $70 to a barrel and remained there for some time. In terms of yields as well, we saw 10-year government bond yield in US drop to around 437. However, after that, rates have been going higher. In terms of macroeconomic numbers, US economy continues to do well and growth remains strong. Inflation remains above target of the US Federal Reserve. Despite this, US Federal Reserve has kept rates on hold in the last few meetings. There is now expectation that the US Fed may hike rates somewhere in September or in the October policy. Of course, the US midterm being in November, it may be again a political decision whether to hike rates prior to the midterm elections in US. In India also, the drop in oil prices was very positive for markets. This was also accompanied by RBI policies and schemes in the FX market to get more foreign exchange into India. The two schemes, one FCNRB deposits, where RBI was taking all the exchange risk and giving banks opportunity to collect large amount of deposits. Till now, as per estimates from RBI as well as markets, about $32 billion have been collected in the FCNR deposits. Further, RBI gave some exemptions and concessions on ECB being raised by PSU corporates in the overseas market. RBI committed to do FX exchange rate swaps at around 1.5%, which is much lower than the market, giving again cost advantage to corporates raising money in the ECB market overseas. This is likely to get precious foreign exchange into India as in the last couple of years, large amount of foreign exchange has been going out in form of sale by FIs in the equity markets. Globally, market sentiment has turned in the recent 1 year to AI-related trade. India does not have any AI-related stocks. So in the last 1 or 2 years, we have seen huge outflows from FIs in equity markets. Currency had depreciated to almost 97 rupees to the dollar before RBI actions brought it down to around 94 rupees to the dollar. However, the currency has again climbed to around 96 handle in the past few months, despite large amount of flows coming from the RBI schemes. Apart from this, government also announced tax-free status for FI investing in government securities. This has also collected about $9 billion since June. Put together, around $40 billion has come since June, first week. However, rupee remains under pressure, likely because of large volatility in the oil prices. Energy situation in India remains critical and a lot of reserves and foreign exchange is used to buy oil from overseas. Coming to rate markets reacted positively on news from RBI on FCNRB and ECB deposits. Also, the FII tax-free status also propelled markets higher. Yields dropped to around 6.68% on the 10-year from about 7%. Short-term rates also dropped faster as liquidity from FCNR deposits will keep markets and system liquidity at a good level. However, after the initial euphoria was over, markets started looking for cues from the geopolitical markets. As oil prices climbed, Indian yields also started to climb with it. While short-term rates remain anchored as there is no change in repo rate in the past meeting, longer-term rates have seen higher moves. However, liquidity situation remains good, and it is expected that FCNRB deposits coming into the markets will give banks opportunities to buy government securities to meet liquidity requirements. Further, expectation of inclusion in the Bloomberg Global Index by September is expected to give demand-side support to the government securities market. Overall, the situation in Indian debt markets remain neutral. While the global situation is giving negative impulses to the market, the local situation remains much more positive. RBI has been dovish in the past few policies, and in media interactions, the governor has also pointed out that rate hike expectations are premature. Overall, market is moving in a sideways direction. Overall 10-year we have seen move between around 670 to 685 range, while the short-term movements are also restricted to a shorter range. However, with a larger supply expected in the second half from government borrowings as well as from state borrowings, rate markets may get pressured from that conditions. The US Federal Reserve is also expected to raise rates, which may put pressure on RBI also to follow the same. This may lead to rate increases, especially in the longer end of the curve. Overall, we see RBI possibly hiking rates by the third quarter or the fourth quarter, following probably a Fed direction in the similar way. In this scenario, investors may choose to invest in short to medium term funds like low duration fund, short duration fund, and corporate bond funds. As usual, investors should look at their investment horizon as well as their risk profile before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.